Hey, this is Sasha Evdokov, and thank you for joining me for another episode of Let's Talk Stocks. Now, in this episode 75, what I'd really like to do is go into some basics and just give you some more insight, some ideas about how options are traded. Now, over the last couple of weeks, I've been busy filming an options course, and I'm still working on that course. There's a lot of material that I've been working on, but I do realize that I haven't really focused a lot on sharing some insight and wisdom, at least on the Thursday lessons here on the webcast that we do in options or about options. And there's a few different reasons for that, really. One of the reasons for that is because options are very different from trading stock. They are a little bit more complicated. In fact, quite a bit more complicated if you don't know or don't understand what you're doing. So the risks can become much greater if you are unknowledgeable and if you are unaware of the consequences and the risks. Now, there are, of course, great upsides. So options really were invented for risk management, and proper risk management with options can actually give you a lot of advantages if you know and understand what you're doing. The problem with options with most people is that they don't know what they're doing. And when you don't know what you're doing, then that's really where you can burn your account and blow your account up and have a lot of damaging consequences when you don't know and understand what happens when trading options. So if you are just joining me, if this is the first time you're listening to these Let's Talk Stock sessions or the lessons, then I highly recommend you actually don't watch this lesson. Don't listen to this lesson. Go and get the basics. Go to the website, tradersfly.com, and just go to the training section and get some of the basics and fundamentals. Once you're in this training section, when you get there, there's going to be a lot of different lessons in here that you can just go and browse through, such as the Wall Street basics and terms, even the trading basics and fundamentals, technical analysis basics, money and risk management basics. So all these things will help get you started on the basics and fundamental level. Now, once you do get into some core material and you're starting to understand things and you want to trade options, what you could do is go through some of the videos that I've already created, such as these little shorter videos, and go through them and learn some of the basics behind trading options. So just search for trading options or options, and you'll see a lot of different videos that I've already created. So I won't be covering exactly all these basics in the sense of going through the basics of these option videos. I'm not going to go in detail about every single one of these things that I've already covered in these videos. My goal for today is to share with you just some insight of different varieties and ways to trade options and how really you should be trading options if you're trading options, because a lot of people have misconceptions about the proper way of trading. Now here, when you're looking at this panel, I like using the Thinkorswim platform. This is the Thinkorswim platform from TD Ameritrade, and the platform and panel that you're looking at is actually the simulated money. So this is paper money. It's fake money. It's not real. It is monopoly money, and this is what I'm using right now to record the courses, in fact. So some of these trades right now that you're looking at are actually trades that I've put on for the course. Now, there's no way to really fake that or backdate it, so this is actual profits that we have made in the course that I'm working on. So don't stress too much about these because we're not going to get into detail about these trades that are on screen. These are just simply trades I have going on right now to do lessons for one of the modules within the courses that I'm shooting, and that's what those are all about. So my goal for today is to share with you how to trade basics of options and how they're traded. I'm not going to go into the nitty-gritty of really the risk management, the money management behind it. We're not going to go into detail about the proper way to make adjustments, the proper way to do the hedging. I want to give you a big overview from a big Google map. I want to give you an overview from an airplane. If you're flying overhead, I want to share with you how to trade these things and the right way that you should be trading these things. So if you're trading these incorrectly, then it can lead to disaster. So the base level behind options is if you look at any stock, any given stock, and let's just take Amazon for example, is that you do have these option contracts here in this module and this panel. Now, this panel is set up very similar to many other panels. Again, this is the Thinkorswim platform, and I have multiple brokers, in fact, and where the panel is very similar to this, and I like using this one to teach because it's very friendly and there's a lot of things that you can do with it. So for this example, we're using the Thinkorswim platform, but most of these platforms that you use, whatever platform you use, they're going to be set up fairly similar. On the left, you'll have the calls. On the right, you have the puts. The calls, if you don't know, this will be a quick refresher. The calls, in theory, if you buy a single call, and you go into buying a single call, we'll right-click, analyze the trade. You're looking for that stock to move to the upside. So you're putting a bet on these on this stock or this equity. Now, through time, this option contract does decay, and this option premium, the price of this is driven through multiple things, but in part of it is due to time value. So every day when you hold on to these, think of them like dead fish. The longer you hold on to them, the more and longer they rot. So $30 per day is what you lose. So as I shift my time value over here, and you can see here as I shift time value, you can see that my profit and loss goes into negative territory. So that is not what we want to do. We want to go back into our standard time frame. So that's what happens with options. The more time that you buy, if let's say you go out to January 2017, and let's see if we can do that. Let's go to the 580s because I don't believe the $5 spreads are being sold at the further out months. So if we go out further out, you're only losing $12 per day. So that's your theta risk. Now keep in mind, you have these additional Greeks and additional things that happen. So this is a delta, gamma, theta, and vega that are completely different and could be a whole lesson all on its own. Each individual one could be an hour on its own just to discuss them. But in general, most people, the way that they trade options is they simply buy a call option like this, or if they believe the stock will go down, they will buy a put option. So you'll go ahead, you'll buy a put option, and now you're looking for this stock to head lower. So your risk is really just the price you pay for that option, which is $85.05. Multiply that times 100, and you get your $8,505. So here you have unlimited upside, but one thing I've noticed over the years is this unlimited upside looks great, especially if you live in the world of fictitious money that comes from the sky. And if you live in that world, then this unlimited upside is amazing, or unlimited profit potential, whether that's a put or whether that's a call. But the thing I've learned is that money doesn't fall from the sky, and these unlimited profits for a stock to go that fast, that quick is usually rare to happen. And with options, since a lot of their value is derived from that time value, most of the time you want to run this like a business. So in general, rather than buying product, think about this like if you're at a grocery store, you're typically buying products. You're buying products and you're spending money. If you go into an Apple store, if you go to an Amazon website, when you buy things, you are spending money. You are losing money. So in here, when you buy this option, you lose money. So you lose money when you're buying options. Get that into your mind and understand that when you're buying options, you're typically losing money if nothing happens and it stays still because of this theta decay, which is your time value, because you have a negative time value when you buy time, because every day that stock stands still, it loses value. It's like having a banana. Every day it sits there, you have less time to eat it. So in the option business, rather than buying options, most people, as far as professionals go, as far as I understand, most of the time, the right way or the more appropriate way to be profitable in this business when you're trading options at least is to go in and sell option premiums. So here we are buying one. But the reality is if you sell option premium, so let's just go ahead and sell one and see what happens. So as I go to sell a single and I analyze this trade, you can see that when I sell an option at, let's say, $565, now every day I make $31 if that option stands still or that price of that stock stands still. And that is because of that time decay, because you've sold something. Think of it again like a business. If you're the business, if you are the grocery store and you sell something, you are making money, right? You sell something, you're making money. If you're selling phones and you sell a phone, you're making money. If you buy a telephone, you are losing money because you've bought one, okay? So you take money out of your pocket and you bought the phone, okay? So maybe you have a tangible product, but that's basically how it works out. So in this scenario, this is how most professional traders make money when it comes to options, is that they sell options. They don't typically buy options. Now, the problem with selling things like this or options is a lot of people don't understand is that you get into this very large loss that you could incur, that if the stock goes not in your right direction, that on a simple option that is costing you right around, well, not the buying power effect, but your profit potential is about $1,960. But if Amazon goes to, let's say, $10.50, you know, your loss is at around $50,000. Now, you can do the same kind of scenario and situation that this stock, this position, if we sell a call, is positioned for me to make money to the downside, or if it stands still. If I do a similar situation, but I do it on a put, and I go to, let's say, 535, now I'm positioned to make money if that stock stands still or moves up. But again, my loss here could be dramatic. This is considered selling naked. And when you sell naked without coverage or protection, this becomes extremely dangerous. Extremely dangerous. You will lose your shirt, and this is how most people lose their shirt, is if they do this on a biotech and it goes against them, they're down about 30 grand. If the stock continues to go down, they're down 40 grand. If you go ahead and leverage this and you do it a couple of contracts, you know, you can go down into some serious trouble. And let's see if we can make this a little bit better adjusted. Right here, you're down about $120,000 on 3 contracts selling them naked. So you don't want to do this until you really understand what you're doing. So that's why the option business can be very dangerous. So how is it that most traders trade these options? Well, what they do is all these strategies are based off of selling a strangle. So a lot of strategies the core fundamental is based on selling a strangle. What is a strangle? Well, a strangle is selling both a call and a put that we just went over. So if you go into it and you sell a strangle, so now we sell a call and we sell a put, and we could sell, let's say this at 565, this is at 580. We'll go ahead, we'll analyze the trade. So now you can see you basically make money from option decay, $58 per day, but you have unlimited downside on both sides. So you're losing money on both sides of these ranges if you sell a strangle. So what is it that you do? Well, in order to offset and minimize this risk, you do need to be a buyer of options. You need to buy protection. That way, if something goes against you, you need to have that physical item in your hand. So if you're selling a phone, but you're not ready to deliver that phone yet, because this is what you're doing. When you do this, you're basically selling a cell phone to someone, but you don't have it in your office or you don't have it in your warehouse ready to ship yet. You're making sales, you're making those pre-order sales, but you don't have it done. They are on a boat from China coming in, and then they'll be sold here shortly. So the problem is if that boat gets lost or a hurricane hits it, you are short, which is what we are here. We're naked. We are short those phones, and all these people have paid us money. So here's the $58. as time goes on, these people have paid us money for these option contracts or for those phones. So now we need to deliver if something goes against us. So that's why you buy protection. Okay, so as an easy example, I guess, to real world and real life situations, what you do is you buy cheap phones or old phones somewhere over here, which would be at the 500 price level. So we'll go ahead, we'll buy a single, we'll analyze that trade. So you can see that caps it right here. So what does that single do? Remember, puts it to the other direction. We did a put. We bought a put, so it helps protect me if the stock goes down, right? So if the stock goes down the other way, I was at risk with just a strangle. So this protects me. It caps it right there at that 500 level. I could get it at 490 and shift that. You could get it at whatever price you want. Then you have the same problem on the upside for the call side. So what do you need to do? You need to buy one on the call side. So you go ahead, buy a single on the call, and you go ahead and you analyze the trade. So again, the problem here is where are you making the adjustment or the fix? Well, you can put it into anywhere. So all these different things are all just option contracts creating a profit picture for you. So that's what you're looking at right now. And this creates a profit picture that's either favorable for you or not favorable. And it's all based right now, at least the current one that we have, off of a Strangle. So what you do is you start making adjustments to where you want protection on the upside, where you want protection on the downside, and that creates kind of at least a limit on your risk. So here on this situation, we have a protection, and our risk here is $4,000. Okay, so our risk is $4,000, and our max profit potential is, of course, $3,458, which is at these highs or peaks right there. If this sits still and expires in that range. So what is it that happens? Well, you go ahead and as time decays and this stock, Amazon, stays between this range, between this break-even point of 614 and 530, then we collect premium and profits. Now, of course, we could shift these around. We could shift these different points at these calls and puts that we sell, and this would create a slightly different profit picture. And you slowly start getting into an iron condor territory. So remember, all these things are just names for a variety of spreads and risks that you put on. Whether that's an iron condor, whether that's a butterfly, those of you that don't know what I'm talking about, just think of this picture as being called an iron condor. Okay, if it's a little tighter without it right here, and without the protection, this is known as a strangle. So all these things, they have different names, but they capitalize and profit from this theta decay. And this theta decay is where you make your money. So as long as that stock stays between this range, you make your premium and you make your money. So there's various ways that you can do this by selling premium. Now all of these happen in 1 month. But if you understand that premium decays quicker, because the premium decay happens on an accelerated curve. It decays faster, 0 to 30 days, and a little bit slower if you buy more time premium, such as 30 to 60 days. Or if you buy a lot of time premium, 90 days, 120 days, it decays even slower then. So if you look at it from just buying a single call, and let's just say you buy a single call at, right now we're at 558. So let's just move the strike price, which is the price we agree on to buy the phone, to buy the house, to buy anything. This is the price you agree on. So here, the theta decay, if we look at it, this is $26 per day in April. Right now, we are looking at the April contracts, which are 36 days out. But if we close this up, you see that they also have July, October, January. So if we went into, let's say, a little bit further, like October, you can see the decay is only $14 per day. If we went into January, it's only $8 per day. So the more time premium that you buy, the less it decays on a day-by-day basis. So as the further out you go. So most people's goal, as far as option traders, the big boys or people that trade options actively, their goal is to sell option premium. And in fact, this is what I like to do in my retirement accounts. Is it's a lot safer to sell these premiums. So how is it that I do it? Well, I'll show you another variation and I'll show you another strategy. So if we look at, let's say, let's just take a look at Google, for example. You can do this on any stock that has liquid options. So here in this variation, again, you go into your option, you look at your near month, 36 days out, and we know that the 36 days out, they go ahead and decay fairly quickly. So I'll go ahead and sell one of these. So when I sell one of these, okay, I'm selling one right here and I'm collecting the premium. Okay, now the problem here is, again, I have unlimited downside risk. Okay, so I have unlimited risk over here as that stock heads higher. So I need to protect it. Well, what can I do? Well, I could go ahead and buy protection, buy another one further out. I could buy one single over here, and this will cap it. This is called a vertical spread. And now I make money as that stock heads to the downside or stand still. But the other scenario or situation that I could do is, if you don't want to do it this way, one of the ways that I like to do it is you go out for the next month, because we know that 30, 40 days, these options decay pretty quickly. The 70 days, they decay slower. So what do I want to do? I want to go ahead and buy my protection further out. So I'll go ahead and buy a single out here. So here we have a 715. So let me change it also to a 715. Make it live price. So now you can see what this does to my profit picture. And this is known as a calendar. So what does that single do? Well, remember, first you're selling one. Okay, you're selling one contract at the April 2016 for 715 at the strike price. So this allows you to capture this $36 in theta. That's fantastic, but you have unlimited risk, okay, if that stock heads higher. Now, buying this single call at the 715, but a further out month, this decays $26 per day. Okay, so that one decays a little bit less. So look at it. We have $26 per day, and this one is $36 per day. Okay, so this one you're making money on when you sell it, but when you're buying it, this one you're losing money on. So the difference between the one you're losing money on, remember, we're buying something here, you're losing money on this one, and you want the stock go to the upside on this one. Whereas on this one, when you sell it, you want the stock to go to the downside or really stand still. So this one, you have positive theta. The other one, when you buy it, you have negative theta. When you buy an option, you have negative theta. So putting them together, see, I have first I start with selling one, then I go ahead and buy one, and now that creates a graph that looks kind of like this. So one of them is coming off of the sell side, and the other one is buying the protection on the buying side. So now here, that sum or difference in that theta is a positive 10. So I'm making $10 per day as that stock stands still and as we continue to move through time. So as you can see, as we move through time, that white line, which is the current line, that is today's line based on the date that I set, as it moves closer to the green area, that is our expiration area. That is what creates and makes us money and income. So basically, if you watch the white line is the current profit and loss for the options. And right now they're a little bit skewed because we're after market hours, so we'd start at a negative. But in general, that white line goes closer and closer to that green line. And as it does, that's how you make your money. That's how you make your profits. And that's how money is made. And you have a break-even point between 690 and 740. So if you look at Google, and if we go to just a standard chart, so if we look at Google and we look at, let's say, a weekly, can we predict that this stock can stay between, let's say, 740 to 690, 740 to 690. So 690 would put us somewhere right around, I guess, this level. So it's not the greatest spreads, but I'm just showing you, and 740. So over here, within the next, let's say, however many days, a week, 2 weeks, 5 weeks, it doesn't matter. You could keep this contract for 5 days, 7 days, and you could get out of it when it's like this. You don't have to hold it to expiration when it goes all the way up. You could hold it for just a few days right here when you make 90 bucks and then you're out. So you could do it something like this. And a simple way to put on these trades, at least from the Thinkorswim platform, is for any trade really that you do, let's just take Tesla, for example, to do a different one, is you simply just go ahead and you just buy that calendar. So when you just buy the calendar and you change your strike price, go ahead, you analyze that trade. If we go to more of the today's date, you wouldn't be starting out with a profit. The market doesn't give you anything. So here, this trade right here would be more like what you're starting out with, and you just start with a calendar. And now, as you change your strike prices, you can shift that calendar a little to the right if you want. You can shift it a little to the left. Okay, 190 over here. But the point being is that you're theta positive on these trades, and you're making money from that decay of the options you're selling in the near month, and you bought the protection in the further out month. So this is another way to trade it. Okay, so there's various ways to trade the markets. And with options, you have unlimited kinds of pictures and graphs that you can create. So for example, there's another strategy that's called a butterfly, which is a very popular strategy. Remember that you can trade any strategy in any market condition that you want. The only difference is that you wouldn't trade a butterfly the same way in an up market as you would in a down market. Okay, you can tweak them. So here, this strategy can be adjusted and fine-tuned. So what do you do in this situation? Well, you sell 2 right there at that center strike price or the close strike price, and then you buy your protection. Again, it starts with the strangle, which is what? Selling 2 contracts, or selling those 2 contracts. They could be a call, they could be a put, it doesn't really matter. And then you buy your protection and wings out. The difference between a butterfly is that you have 2 right there in the same price point, in the same strike prices, and that's where you have a lot of decay that starts to kick in. So your theta, your day decay per day, is $10 roughly. Of course, this also depends on Vega, how the stock moves with the price, and there's a lot of other factors that go with it. But in general, you're making $10 per day as this time decay continues to move day by day. And this continues to accelerate as you get closer to expiration. So as you get into a few days later, you can see it gets into $19 per day and $20 per day. So that's really what happens as that price bounces around and you just collect your premium. Now you can adjust these into doing something, let's say positioning it more for the upside move. So let me bring this date right back down to normal. So you could position these a little bit more to the upside. So let's say I drop one of these legs, or wings as they're called, down on one side. So now it allows me to capture a little more room to the upside. Okay, I could bring this in a little tighter. I could make it look something like this. So there's a lot of variations to what you could do with options, because it gives you options, or it gives you variations to creating spreads and profit pictures that you really, I guess, can live with, or can look at and say, hey, I'm comfortable with this. Maybe if you're not comfortable with this, then you go ahead and tweak it. So I say, I want it a little bit lower because I don't like the risk on this downside. Okay, maybe this downside risk looks a little too much. So I'll go ahead and tweak it and pop it up a little higher. So there we go. That curve looks a little bit better. So my current white line right there, that's my profit picture. And you get to tweak it and adjust it how you want it. If maybe you believe that stock has higher room for the upside, you could go ahead and shift this even further, move that center point to maybe the 220s. So again, you can shift these any way you want, and there's all kinds of strategies. If you look at the platform and the panel, if we do something, let me see if I can show you here. There we go. On the buy side, you can see that there's a single, there's a vertical. Typically, most beginners trade singles, but remember what I said about the singles. You're losing money every day if you're buying them. If you're selling them and you're selling singles, which is naked selling, typically most beginners aren't allowed to do that. You have unlimited risks in those directions, which is also very different and very risky. You could do verticals, which is something we just dabbled in. You do have back ratio spreads, the calendars we talked about. The diagonals is like a calendar, but it's offset, and you can skew those calendars. So if we do a diagonal, and you go ahead and let's just say we do something on the 240, and this is you buy protection a little bit on a different strike price. So let's get rid of this butterfly, uncheck it. Just look at the profit picture. Don't worry about what my mouse or where I'm clicking at the moment. So this, what happens is this can skew your profit picture. And what it does is it skews it to one direction like this. So if, let's say, our price is 204 and we go ahead and let's say we're at the 210 and we have a 240 for the protection, it skews that profit picture to look a little bit more biased for the downside. If I do it the other way, and let's just say I go and buy my protection at, let's say, 195, now it goes to the bullish side. So you can see I can flip it however I want. Or I could make it pretty much a calendar right here. There's our calendar. If they're both the same, 210 and 210, it's a calendar. And if I wanted just a smidge, a small tweak, I could do a 205 and a 210, which is a spread difference. And now it allows you to position to the upside just a little bit to compensate for some of those Vegas. And you still get your theta, your $8 per day that you earn when this position or this stock stands still, and as it continues to head higher, you're also making profits. And you can position these in all sorts of ways that you want. Something like this, where if you want a little more room on the downside just in case, but you have room to the upside. So as that stands still, that white line gets closer to the expiration line, which means the white line is the current date or the current day line gets closer to the expiring month's time frame, which would be our closer month. Here would be April. And then you collect your premium, your theta, on a per day basis. Okay, so that's how that works. And that's what I wanted to share with you here is the way that you really should be or could be trading options. If you're the one that's selling simply the calls or selling the puts, this is perfectly fine, and it's not a bad problem to do, or it's not a bad strategy to do. So let's say you're trading Tesla here. This is, I guess, the basic way to collect premium from what many people do in their retirement accounts is if you have stock, typically what you can do is simply sell a single call. So if you go ahead and sell a single right there, and we sell it and we look at it. Here's what it does is I like doing this even if you own stock, because remember, a stock to shoot up to the moon is very unlikely. So if you sell something a little bit further out, the likelihood of it getting to that price point is, I guess, slimmer. Okay, it's the likelihood of Tesla going to 200. Right now we're at 204 in Tesla. So if you look at Tesla, right now we are at 204, 205. The likelihood of it getting, let's say, to 295 or 300, what are the chances? Let's say it gets to 300 within the next 40 days. Probably slim. How about 250? Slim, but possible, you know? So let's just say it's a 50-50 shot. Well, with the 50-50 shot here, what you can do is, remember, you sell this premium just like here, but you're not protected, because that means if you sell this call and the stock goes to 280, just like in one of my earlier videos, I talked about it, that if it goes to 280, you would be forced to deliver that stock at the 245 price range, but the stock is at 280. So you'd have to buy it at 280 and sell it for 240. So therefore, that's why that loss is created. But if you already own the stock, let's say you bought the stock right now and you decide, hey, I want to sell the calls right there. So I sell the calls. So now if that stock gets to 245, then I'm out of my stock, but I already have my stock. I bought my stock at, 204. So that means that I would, if this happens and the stock gets to 260, I would, number one, collect my $234 right here of premium because I sold this contract. And I would also make the profit up till 245 on this stock. Okay, so I would make my, whatever, $4,000. Now, if the stock gets to 270, I could have made 6,525. But the likelihood of that is, well, you need to determine that. So the likelihood of it getting to, let's say, 270 in the next, how many days do we have? 36 days is slimmer, right? So if it gets to 280, I could have made, or if we get to 270, I could have made 6,500. But unfortunately, if you sold that one contract, which is 100 shares, one contract is to 100 shares. If I had 200 shares, I would sell two contracts. So therefore, if it gets to 260, I still only make at expiration, which is still only, right, $8,588 because I make the price value of stock appreciation plus what I sold these contracts for, okay? So at 260, I would make $8,588. At 300, I would make $8,588. At 340, I would make $8,588. But if I had just the stock, I would at least at 300 would have made $18,000. So I would have made nearly double or triple that amount. Now, the difference here is if you're selling this upside call and you're collecting your $468 from selling these calls, if that stock gets down and moves lower, let's say it gets to 170, well, let's say it gets to, not to 170, but a little lighter. Let's say it gets to 190, you're losing $2,594. But if you didn't sell that and it gets to 190, you're losing a little bit more, $2,700, because you're still making money on this premium. So if you sold a single call and the stock goes to 170, you're still making your $468. So in fact, it limits your losses to some degree by collecting that premium of $468. Now, you can do the same thing kind of to the put side as well, and you can sell the puts, but that's a whole different discussion. My whole goal for you for this video, I wanted to keep it simple to show you that there's a variety of ways to make money from the market. And when it comes to option trading, there's a lot of complicated things that can happen on trading options, and you can do all sorts of things in a variety of strategies. Don't be sucked into just thinking you need to buy a single option or sell a single option, because that's typically where a lot of losses happen. I wanted to just share this with you just to give you some basic insight. Options on their own are very complicated, and that's why the course I'm working on right now is actually one of the largest courses I probably will ever release. It is already, we're pushing a lot of hours into just the video recorded material, and we're not even halfway done. And this subject matter is very intense. And if this video was overwhelming for you already, you definitely want to go back then and just look at some of my older option videos right here and just look through these option videos. Search for them and go to the Traders Fly website and go to that category of options, and it'll give you some more insight about all these different strategies and about some more option basics. But here, I just wanted to share with you just some of the real ways that option traders trade options rather than a simple buy or sell an option. You got to really look at it multidimensionally, and later, as things happen, what you do is you'll start stacking multiple things on top of one another. And I'll give you a quick little rundown here of this course that I'm working on right now. Is we basically have a few variations here to this strategy. This is more of an iron condor. We have some put selling and call selling here. The QQQ, we have a tweaked iron condor, and this one also an iron condor. Obviously, this is for filming the iron condor section, but as you can see here, I'm going to show you what's going on. Just a brief insight right here. In Apple, on this position, we're up $158 in basically about a week as I've been filming and recording this. We have 8 contracts on this side. On the left side, the put side, because we were expecting that stock to go higher, and we've skewed it a little bit. And we have 7 contracts on the other side, the call side, the right side. So to hedge that position, to protect it. So as long as Apple's in between here, you'd collect your money. The QQQs, again, we did a smaller spread here. This one is a skewed position that we started off a little bit differently. So again, the same thing. We're up $18 on this one, but you can see that you create this concoction of spreads. And then you have the SPX right here also starting to come into profitable territory. Not yet, but it'll get there. And when you start looking at this as a portfolio, this is where a portfolio really starts to look like a portfolio. So what I've done is put this on a portfolio beta weighted on the SPX, and you can see it creates this kind of profit picture right there. Now, I think we have some simulations. I can hide those simulations, and you'll see it fixes all that. And this is our basic portfolio. So as far as our account and portfolio, we are up $153, $58 right there since we've put it on, and $39 per day. We're making $35 per day just in Theta, plus whatever, if we can get into the price of more favorable pricing, then that'll also help us as well. But in general, since the market didn't do much today, we basically collected our Theta right there, which was right around $35, but we got $39, just potential due to the volatilities, potential due to some Vegas, and so forth. So hopefully this gives you some insight on options, how they're supposed to be traded, the more appropriate way to be trading options. And I just wanted to share with you that insight so you don't get overwhelmed behind options. And you definitely have to put some time and study into these kinds of tools and vehicles to trade. And if you're brand new to the market, I would say less than 3 years, stay away from options for the time being until you get more knowledge and more education, because that's where the key is education, education, education. Learn what you don't know, learn what you need to know, so that way you can evolve your craft. And you could simply take one simple strategy, whether that's just having horizontal support and resistance lines and having that stock when it breaks that line to continue to go higher. And you could just have one strategy, and that could be all the trading you do, and that's perfectly fine. You could simply do just one of the calendars that we talked about and just do calendars all day long, or iron condors, or just do verticals. It's up to you. There's so many ways to trade the market. There's so many ways, and you can make money doing it in all kinds of different ways. It's just a question of which method resonates with you and which one hits to your liking and which one fits your risk and reward profile. So hopefully this was helpful. If you have questions about options, then I would rather you either send a very detailed question if you're doing a comment in the YouTube or any comment somewhere on the websites. Make sure it's very detailed because options can be confusing. Otherwise, I'll try to keep it simple and get back to you when I can, because they can be confusing. If you have a profit picture, if you have a position that you want to look at, it might be better to send a screenshot or do it through email, because they are complicated, and sometimes it's just very difficult to explain or answer questions for these kinds of things through the comment system. So I might give just a short response, and that is simply just because the complexity behind them. So try and keep your questions very simple but to the point if you have any questions, and I'll do my best to answer them. All right, thanks again for joining me. I'll continue to film more of this options course as we get through it. It's a lot of work. We're pushing I think 27, 28 hours on the video material, and continue to do the markets, do some trading as well. So the market's a little bit extended if you were curious about the markets. We're hitting these S&P highs, and on that 2000 level, it's struggling to get over it, but this volatility and push really it may break out, or it may start selling off. And then if it starts selling off, you could watch that 1930, watch that these price levels and these points right here. So you got the 1930, you got the 1865, 1870, and you have the 1809, 1810, 1812 levels. So those are some of the levels that I'm watching. Those are key levels. If we break above that, you'll probably isolate right there in that range. Right now, we're in this trading range. So that's really all the market's doing, and that's the way it's acting and behaving. I've posted some critical charts this week, so check those out and take a look at some individual stock positions and how things are moving, and get some more insight about stocks. Of course, we do, when we post the charts on the critical charts, you do get one free chart on these critical charts. So just go ahead, hit the logo right up there. And once you hit the logo, you'll get into the post and see all the posts, and you'll see that right there we were posting one of them, and you'll get to see the charts. And you can reference back to some of the old charts as well and look through those charts. And, because those charts, the charts don't expire. The trend lines are still there. So feel free to browse through and look at some of the other charts in the past as well. Thanks again for joining me. Hope you have a great rest of the week and enjoy your weekend. And I will see you next week.